Hi, this is Melvin again from the econstutor.com, and today I'm going to run through a second part pertaining to the topic on macroeconomic goals and policies. Okay, so while the last discussion focused on the 103 exercise and how you combine causes and consequences, okay, of macroeconomic objectives, today I'm going to share with you the A3 exercise, okay. And in this exercise, we'll be looking at how to combine our understanding of the causes of macro goals as well as policy solutions. Okay, right. So let's start with one example. Suppose I'm looking at unemployment. Okay, and I'm interested to know what are the policy solutions to tackling this problem as well as the evaluation, okay, of these policies. So I believe that a comprehensive, okay, understanding of macro policies should always start with an understanding of the root causes of the problem. So let's say I look at unemployment. I'm going to break this down into the three main types. There's cyclical unemployment, structural unemployment, as well as frictional unemployment. And we know that cyclical unemployment, okay, happens when there's a fall in C, G, I, or X minus M. Okay? And when I say root causes, we really need to drill down into the underlying factors that affect C, G, I, and X minus M. Okay? So we know we know C is affected by income changes, specifically a change in disposable income. Okay? It's also affected by credit. Okay? In fact, when you talk about the cost of credit, you're basically referring to interest rates, okay, which is the cost of borrowing money. It's also affected by the state of expectations. Okay, so in short, I call this ICE, right? So they refer to the three main factors that affect consumption. G, on the other hand, depends on the government budget as well as the goals of the government. Okay, so if the government is looking to boost the number of jobs in the economy, they will be running expansionary fiscal policies. All right, investments, they are primarily affected by interest rates, the level of corporate tax, which affects the cost of doing business, okay, as well as expectations as well. So you can see, again, ICE is a very useful acronym, okay. X minus M depends on three things. First, the price competitiveness of a country's exports, which depends on exchange rates as well as inflation rates. Net exports also depends on income levels. And finally, quality competitiveness, okay, of the country's products. So we have peak, PIQ for short. And structural unemployment is quite straightforward. It arises due to a mismatch of skills. Okay, and this usually happens when the economy is in transition between industries. Frictional unemployment, on the other hand, arises due to imperfect info flows, okay, between employers and employees. Right. So now that you have the root causes of unemployment all laid out in front of you, the next step is actually easy. Okay? Suppose I want to see how fiscal policy works. Now, I know that fiscal policy consists of mainly government spending and taxation policies. Okay? So to check how fiscal policy works in addressing unemployment, we simply need to circle the respective root causes which pertain to either a change in G or a change in T. Let's work through one example. Okay? Now, if I look at cyclical unemployment, clearly the level of income tax affects disposable income. Okay? The level of corporate taxes affects investments through the cost of operations, right? While a change in government spending affects G directly. Okay? Now, once you've done this, you can see that the areas where you have not laid a circle or where you have not circled this root factor shows you how or where fiscal policy cannot exert an effect. So I don't see a circle under frictional unemployment. Neither do I see a circle under structural unemployment. Now, while fiscal policy can indeed change domestic income levels, it cannot influence external income, which is the main driver of export sales. All right, so you have three drawbacks of fiscal policy now. Okay, first, it is less effective against external demand. Okay, so if let's say cyclical unemployment has come about due to a fall in X minus M, fiscal policy is probably not the best policy to use. Okay, second, it also doesn't work against structural unemployment. Now, same, okay, it is less effective against frictional unemployment as well. So there are three drawbacks here. And what about the benefits of fiscal policy? We can see that fiscal policy, okay, increases AD through a rise in C, a rise in I, okay, or a rise in G. So these are the benefits, or they show you how fiscal policy works. But if you consider the other factors, all right, for example, if I look at consumption spending, the level of expectations is another factor which affects consumption. Okay, so while fiscal policy can affect the level of income, effectiveness still depends on the level of expectations. Same thing for same thing for investment spending. Although fiscal policy can influence the level of corporate taxes and hence affect the level of investment, it also depends on investor confidence. Okay? Finally, while a change in G can increase AD directly, it also depends on the availability of budget. Okay, so even though the circles show you how fiscal policy works, it can also show you that there are other factors out there which affect C, G, and I. So fiscal policy is not all powerful, and this is precisely the point we want to achieve, or rather we want to acknowledge, because if a policy is not perfect, then there is room for complementary policies to come in. Okay, so if you refer to my guidebook, you'll see the A3 exercise, all right, being worked out. So first, I will show you an example of how the A3 exercise works. And this is what we've seen, okay? Fiscal policy can affect growth. Now, the example we considered earlier was unemployment, but now we are looking at growth. It shouldn't be that much different because AD changes both actual growth and cyclical unemployment, okay? So a change in fiscal policy can affect income, government spending, or the level of corporate taxes, right? But we recognize that there are limitations. So it depends on expectations as well, and the availability of budget, okay? So these show you the limitations of fiscal policy. So if you scroll through the rest of the book, you'll see the A3 exercise being applied, okay, not just for fiscal policy, or rather not just in the case of fiscal policy, but I do the same for interest rate policy, exchange rate policy, as well as supply side policies. Okay, so I've marked all the policies based on different color codes. So the circles represent where policies are able to exert an effect. The dotted lines represent the limitations of each policy, and not forgetting the areas where you have no circle, okay, they are also indicative of the limitations of that policy. So following each A3 exercise, I would have a list of pros and cons of each policy. Okay? So all four policies are there. And we don't do that for just economic growth, right? You extend the same thing to unemployment, okay, to inflation, as well as the balance of payments. Okay? So this is one way for you to marry causes as well as policy solutions. When you do this exercise, okay, every goal requires you to consider how each of the four policies work. So you do it for 4 goals, just 16 iterations altogether, which is exactly my point, okay? Once you run through 16 iterations, you'll be very familiar, okay, with the concepts as well as the standard evaluative points pertaining to the users of policies. Okay, So I hope you find this useful. As usual, if you have comments, you can contact me at that okay, at gmail.com. Okay. If you're interested in buying a copy of the reference book, you can also drop me an email, or you can just call me at 900706248. Okay, that's all. Thank you.